This company evolved from cooking the books to opening shady offshore accounts to a treasurer transferring money to a Lebanese speculator who did not exist, Mr. M. Yas.
What name did you suspect that was?
My ass, you know.
This story is known by lots of business students and it's even studied by advanced students as a case study. The Enron Scandal reveals how greed can become the best of a human being. Lives were lost while jobs and retirement funds went up in smoke. Billions of dollars were stolen and stock price that peaked at $90 per share dropped to 26 cents. A company worth $60 billion in value went bankrupt in less than a month, and there was a fraudulent CEO who acted clueless. How the whole scandal went down was really complex, and we are going to break it down together. This is the case of the Enron Scandal. The story begins in 1985 when two companies merged. They were Texas-based Houston Natural Gas Company and Internorth Incorporated, which was based in Omaha. The new company will almost be named Enteron, but was dismissed and shortened to Enron. At the early stages, Enron was simply a natural oil and gas company. Eventually, the company will begin to trade in stocks, bonds, derivatives, broadband, and even trade the weather. That's right, the weather, but I'm getting ahead of myself. Kenneth Lay became the CEO and chairman of Enron. He was in the same position at Houston Natural Gas at the time of the merger. The ambitious Ken was born April 15, 1942 in Texas County, Missouri. Lay's father was a preacher and the family moved around a lot. But Kenneth went on to study economics at the University of Missouri. He later became a doctor of philosophy in economics from the University of Houston in 1970. Before Ken became a CEO, he had been with companies like Humble Oil, the Office of the Assistant Secretary of the U.S. Navy, Federal Power Commission, Florida Gas Transmission, Continental Resources, and then Transco Energy Company. Because of Ken, Enron was well connected politically. He was a friend of the Bush family, including former President George Bush. He made monetary contributions and was co-chairman of Bush's 1992 re-election committee. He had a number of connections in the Republican and Democratic parties. These connections will favor him and the dealings of Enron immensely. After the merger, Enron still had some lingering problems left over. Ken sold off parts of the company that he believed didn't belong in the future of Enron. Enron reported a loss of $79 million after the first year of operation. In the second year, Enron reported a net profit of $556 million. But its actual profit before interest and tax was $230 million, with interest expense of $421 million, which meant Enron would make yet another loss after interest and tax was deducted. Then, in 1987, 2 years after the merger, something went wrong in the company. Two oil traders working for Enron had traded beyond the limits of Enron and pushed funds into their personal accounts without authorization from Kenneth Lay. This was brought to Ken's attention by auditors, but he took the report at face value and encouraged the traders to keep making Enron more money. The two were later convicted of fraud and filing of false tax returns. Ken Lay acted shocked, saying he was not aware of the reckless gambling and theft. One of the convicted traders was then sent to jail for a year. Meanwhile, the company still had debt to pay and the interest was almost twice the profits made. Mr. Lay was desperately looking for fresh ideas, any idea that would prevent the Enron ship from sinking. In 1988, Enron added power plants and cogeneration units to its portfolio. In 1989, Ken met Jeffrey Skilling, who was then a consultant at McKinsey & Company. He advised Enron to turn natural gas into a commodity. This idea was known as the Gas Bank. The division was flourishing and Skilling was promoted to become the head in 1991. That same year, Enron adopted mark-to-market accounting. This meant that the company was going to record revenue on the day that a contract is signed. In fact, they were creating imaginary revenues. The contract would be worth whatever amount Enron says it is. An example was Enron's deal with Blockbuster, the store you go to rent movies from in the past. Enron wanted to do this online, but after 8 months, the venture was a total flop. Enron made no cash from this online video renting business with Blockbuster, but it still wrote the $150 million down as part of its revenue. On paper, things looked really good for Enron, but in reality, they were making losses on so many levels. Skilling then hired Andrew Foster, also known as Andy, to help. In 1993, Andy designed a complex web of companies. They were limited liability special purpose entities that solely did business with Enron. He used off-balance sheet special purpose vehicles, or SPVs, to transfer Enron's liabilities onto the books of the entities that he created. This allowed Enron's audited financial statement to appear debt-free, but it was $30 billion deep in debt. Enron's stock price was increasing because of this, and they maintained high investment-grade credit rating. Gambling on the prices of natural gas was not enough. Enron decided to gamble on the weather. You heard me right, the weather. People would predict if it would snow or rain or if the sun would come out to play. However, most of the weather derivatives was centered on temperature. Skilling also put Liu Pai, a Chinese-American businessman, in charge of multiple Enron subsidiaries. Pai was CEO of the Enron Energy Services from March 1997 until May 2001. He will become very interesting later in this story. Pai was known to be introverted and as Jeffrey Skilling's top lieutenant. The documentary film, The Smartest Guy in the Room, referred to Pai as the invisible CEO. Over the course of the 1990s, Enron made a few changes to its business plan that greatly improved the perceived profitability of the company. A notable change was their involvement in the California electricity crisis. Enron began operations in California in 1998, providing electricity to the state. However, it was alleged that Enron manipulated the market to increase electricity prices. There were rolling blackouts, and this caused an 800% increase in wholesale prices from April 2000 to December 2000. Governor Davis declared a state of emergency, and the former President Bush did not want to step in. He is friends with Ken and did not believe he had anything to do with the blackouts. By 2000, Enron's share price had gone as high as $90 per share. They had been named America's most innovative company by Fortune for the 5th consecutive time and was on Fortune's 100 best companies to work for in America list. Enron also announced that they were going to open trading for their own broadband, a high-speed fiber optic network that formed the backbone for internet traffic. And investors were eager to trust their monies with Enron. The broadband was a failure, but their stock trend was good, and just 3 years ago, they were in the $20 per share range. Today, it is well above $80 per share. Even you will be enticed to invest your money there. In addition, their financial statements was filled with statements saying how they are expecting future growth and success. They had incredible revenue growth, low debt, and a solid history of increasing stock price. All these were just on paper though. In about a year, the stock price will plummet to as low as 26 cents. In 2001, Fortune magazine published a piece on Enron with title, "Is Enron Overpriced?" In the piece, there was lack of clarity on how Enron was making its money. This was a red flag to investors, and some investors started selling their stock. Things intensified when all of a sudden, in August 2001, Jeffrey Skilling resigned from Enron and sold almost $60 million in Enron shares. Meanwhile, he encouraged Enron employees to buy more. Before this, his top lieutenant, Liu Pai, had left Enron with over $250 million in June 2001. As soon as Skilling's resignation hit the streets, investors began to panic and the stock price of Enron began to fall. Kenneth Lay, who was chairman of the board of Enron at the time, had to step in and take back his role as CEO. He assured employees and investors that it's business as usual and that nothing has changed, but there was fire on the mountain. Sharon Watkins, the then vice president of Enron Corporation, alerted Kenneth Lay just a day after Skilling resigned about the accounting irregularities within the company, warning him that Enron might implode in a wave of accounting scandals. Ken did not do anything about it, and in mid-October 2001, 2 months after her meeting with Lay, Enron announced massive losses. What was once the nation's 7th largest company sought bankruptcy protection by year's end. The Wall Street Journal wrote a piece about some of Andy's dealings, and soon SEC launched an informal inquiry. At this point, investors were giving up on Enron. Around the same time, the auditors of Enron, Arthur Andersen, was busy shredding documents they had on Enron. So aside shredding documents, what else was Arthur Andersen doing to protect investors from fraud? The auditor reviews and verifies the accuracy of financial records and ensure the company's position is fairly represented. Investors can confidently use the audited report of a firm to make informative decisions if the auditors had done their job properly. But they weren't really doing their jobs at all.
I have a specific question for you, Mr. Duncan. You were fired by Andersen last week for orchestrating an expedited effort among the Andersen-Enron engagement team to destroy thousands of paper documents and electronic files relating to the Enron matter after learning of an inquiry by the Securities and Exchange Commission into Enron's complex financial transactions. Did you give an order to destroy documents in an attempt to subvert governmental investigations into Enron's financial collapse? And if so, did you do so at the direction or suggestion of anyone at Andersen or at Enron?
Mr. Chairman, I would like to answer the committee's questions, but on the advice of my counsel, I respectfully decline to answer the question based on the protection afforded me under the Constitution of the United States.
Will you invoke your Fifth Amendment rights in response to all of our questions here today?
Respectfully, that will be my response to all your questions.
You might be familiar with the Big Four accounting firms. There were actually 5 back then, and the 5th firm was Arthur Andersen. Arthur Andersen didn't survive the scandal. You see, auditors survive by their reputation. When investors see that KPMG audited a set of statements, they trust that they are accurate. But now, if Arthur Andersen audits something, the investors are still going to question the accuracy of the audits. All of Arthur Andersen's customers switched over to one of the other 4 firms. This scandal revolutionized the rules of accounting and the accounting industry. Auditors now have more stringent rules on conflict of interest and independence. Arthur Andersen, however, was convicted of obstruction of justice. For the thousands of people who held Enron stock, the stock market was frozen at $32, and when it reopened, it was at $9 per share. However, Cliff Baxter, a trader who was close to Skilling, cashed in $30 million from Enron. He was called to testify in court, but then he drove down a quiet street and shot himself. The investment banks like JP Morgan and Citigroup Inc. were in bed with Enron. They knew the company was recording borrowings as revenue and still advised investors to put their money there. They agreed to pay almost $300 million in fines and penalties to settle accusations that they aided Enron in misrepresenting its true financial condition. However, the main people that were responsible for the fraud were the management of the company, and 2 executives from the company are heavily blamed, Kenneth Lay and Jeffrey Skilling. Andy, the CFO, pleaded guilty to conspiracy to commit wire fraud and testified against other executives. He cut himself a deal and was sentenced to 10 years but only served 6 and paid $23 million in fines. Ken and Skilling were both found guilty of conspiracy and fraud, among other things. Ken Lay was facing 45 years in prison, but died of a heart attack a month before his sentencing in 2006. He was 64 years old. An estimate of 29,000 workers lost their jobs and retirement packages. However, other people involved in the scandal walked away with millions of dollars and sold their stock right before the massive drop in Enron stocks. Skilling was sentenced to 24 years and $180 million in fines. He only served 12 years of his 24-year sentence and was released in early 2019. Skilling is, however, applying to return to the energy sector. Only 2 months after his prison release in early 2019, Skilling was entered as a manager of a new company which he founded a few years ago. Skilling's top lieutenant, Leo.Pi, who left Enron with his $250 million, was never convicted and is reported to be helping Skilling regain connection and funding. SEC banned Skilling from heading any public company, so if his enterprise stays private, he can do whatever he pleases with his company. But with his reputation destroyed, it will be interesting to see how he built himself back up.
What volume from 135? 138,
What price are you at?
It's like I'm blind. I can't see what's going on. I don't know what the market price is. The way they used to deal with it, if you needed something and you needed it now, it could take you hours, days.
When did the price change?
What is the real price?
What is the real price?
The price was hidden, and it took an incredible amount of work to dig it out. Enron Online will change the markets for many, many commodities. It is creating an open, transparent marketplace that replaces the dark, blind system that existed. It is real simple. You turn on your computer, and it's right there. And if you want to do business, you push the button. That's our vision. We're trying to change the world.
This is the end of the Eron Scandal. Free advice though. Always look at a company's cash flow statements before you invest in it. Scandals like this happen all over the world. Investors trust their monies with companies, and companies throw their fiduciary responsibility out of the window. My condolences to all those who were affected by it. Thanks for sticking with me to the end. If you like this video, please don't forget to give it a like. And as always, I can't wait to see your thoughts down in the comment section. We upload videos every week, and you can be a part of the family by hitting the subscribe button. Until we meet again in our other videos, please take care of yourselves and each other. Goodbye.